Welcome traders to another Tickmill trading update with me, Patrick Munnelly. Want to update the SP500 view using the emini futures contract and put together a trade plan with some action areas and high probability price targets for the trading week ahead. Before we jump into the technicals, let's review the market dynamics, the market narrative. Obviously, we have over the weekend the US striking Iran, trying to take out their nuclear facility, which has meant that the market gapped down pretty significantly overnight. But as is often the case, the anticipated market reaction is faded, and the futures are now pointing to a positive open, up 0.07%. Heading into Monday's sessions. So we will be alert this week to certainly this period now where we haven't seen Iran make any retaliation. Waiting to see now what that may look like. The comments coming out of Iranian officials are that it's going to be something significant, but as of yet, we haven't seen any actions. So that's really going to be the key headline risk as we head into this week. In terms of other data on the macro side of things, we will get S&P global PMIs today, existing home sales today, and then Tuesday, Wednesday, we will hear from Fed Chair Powell as he is in front of Congress and the Senate on Wednesday. Then Thursday, we'll get durable goods, GDP, final prints, and jobless claims pending home sales. And rounding out the week on Friday, core PCE and Michigan final statement also released on Friday. In terms of the market, last week finished down 0.2% for the week, up 0.9% for the month, and up 1.5% for the year so far. Early week strength pushed the index into close or within reach of all-time highs before obviously backing off. In terms of the one time framing, on the daily, one time framing down, which will end at 60.71. On the weekly, still one time framing up, which ends at 6,003. Monthly one time framing remains positive, and we are looking at volatility. The VIX at the moment trading at 20.8. The line in the sand for the VIX currently is 21.35. If we're trading above there, you can expect increased probabilities of market action. But whilst we're trading below there, and if we can get back below the 20 level, then liquidation risk significantly decreases. In terms of market breadth, it was mixed for the week last week. Stocks above their 20-day moving average finished at 46%, which is up from the prior week, but still under the 50% level. Over the 50-day moving average, finished at 64%, down from the prior week. And over the 200-day moving average, so that longer time frame trend, finished at 45%, which was also down from the prior week. So we're seeing a little bit of a decline in terms of momentum from the buy side, so we'll want to keep an eye on those references as we head through the week. The VIX curve is still in contango, but fairly flat, so it's consistent with the churn that we have been seeing in the markets. At the money, volatility remains relatively flat as well. We'll see how that develops as we head into today's session, and certainly if we do get any action from Iran, I would expect a potential spike. But like I say, 21.35 is the first reference point, and then anything above 22 would mean that we're likely to see some increased risk of liquidation events in the market. In terms of the gamma options expiration, now obviously behind us on Friday. And gamma is sitting at negative 132 million. Finished the day in negative territory for the second day in a row. And while this certainly can be due to the OPEX on Friday, given the gamma dynamic now being negative, that will mean that market makers will essentially have to chase moves up or down, and so that does add to volatility risk. So I want to keep that dynamic in mind. So let's move to the charts and see where the technicals play out at the moment. So daily volume weighted average price is bearish, and that will only change on a close above 60.47. The weekly volume weighted average price remains bullish, but that would change on a close back down below 59.80. So those are some key reference points in terms of momentum on the weekly and daily time frame. In terms of the weekly bull bear zone that I'm going to use this week, it's going to be the 60.50 to 60.60 area. So any initial move up into that zone, looking for intraday bearish reversal patterns to engage on the short side. You can see my current book. I'm long the dollar, and I'm maintain a short position from last week in terms of the futures, which I'll be potentially looking to add to, and I'll explain in terms of the intraday setup where I'll be looking to do that. So let's also have in mind the weekly expected range given market maker positioning. So 6130 is anticipated range resistance, and 5900 is anticipated range support. You'll note here on the daily time frame, I'm tracking a potential Elliott wave sequence. So we have a 1, 2, and potential wave 3 high. The wave 4 low, given the measuring in terms of scope and scale from the wave 2 pullback, would actually see us trade into 57.31, and then we'd be anticipating that we have a wave 5 extension to the upside. And if we use a 5 equals 1 objective, if this pattern plays out, let's just get that measured correctly. So if we hold that 57.31 area on any pullback, you actually see us 5 equals 1 would be 64.42. Keep that in mind on the weekly time frame. We continue to get closes above the 78.6% tracing of the tariff pullback, and that gives a 127 extension target on the upside at 65.27. 64.91 being the yearly R1 pivot. So those are some of the upside targets if we do get a meaningful pullback, likely driven by geopolitical risk into that 57.31. That could be the launch pad for the next wave to the upside. So looking at the intraday timeframes, what I'm anticipating today is that I'll be looking for any move up into the 60.50, 60.60 area. I'm watching for bearish reversal patterns there. The next downside objective is going to be an equality target versus this swing structure, and the swing high at 60.71 from last week gives us 59.31 on the downside, and roughly coincides with projected trend channel support. And we have a high volume area just below there as well. So anything into that 59.30 and down to 59.16 would be an area I'd be watching for bullish reversal patterns. Like I say, then engage on the long side for a counter trend move back up into test the midpoint of the current corrective channel, which would take us back into 59.88. The alternative scenario would be that we take out the anticipated resistance zone and the bull bear zone for the week at that 60.60. If we get acceptance above there, we're going to look for a retest of that 59.71. But then as the 60.50, 60.60 acts as support from above, we will then target a retest of prior cycle highs here at 6109, and then on into test the projected range resistance for the week at 6130. As always, traders, plan the trade the plan, and most importantly, manage your risk. Until next time, thanks very much.